Hello and welcome to KPMG's podcast to discuss the issuance of ASU 2013-07, Presentation of Financial Statements, Topic 205, Liquidation Basis of Accounting. My name is Jeremy Peters. I'm a Senior Manager in KPMG's Department of Professional Practice. This podcast was recorded on August 9th, 2013. And for the next 10 minutes or so, I'll highlight some of the key provisions of this ASU as well as accounting required under the liquidation basis of accounting. And flipping to the first slide, as you're probably aware, in April of 2013, the FASB issued ASU 2013-07, Liquidation Basis of Accounting. So this ASU creates a new subtopic, 205-30, Liquidation Basis of Accounting, which is under Topic 205, Presentation of Financial Statements in the Accounting Standards Codification. So the question is really, why is liquidation basis being addressed? And the answer is really that under current U.S. GAAP, there's minimal guidance to address when and how to apply the liquidation basis of accounting. So as a result, diversity in practice was observed by the FASB staff. And so the liquidation basis of accounting ASU was issued, and it's intended to clarify both when and how to apply the liquidation basis of accounting, as well as to provide principles for the recognition and measurement of assets and liabilities. Additionally, this ASU amends the master glossary and defines a new term, liquidation. I won't spend the time to read the entire definition because it's quite long, but I'll highlight that the key points are that it's the process by which the entity will convert its assets to cash and settle its obligations in anticipation of ceasing all activities. The other important point that the liquidation basis definition does is it highlights what liquidation is not, and it is not dissolution of an entity as a result of being acquired or merged, where there's an expectation of continuing business activities. So with that as a foundation, let's move into some of the key provisions. If you move to the next slide on recognition and scope, and this is one of the key provisions that I wanted to highlight during this presentation, as one of the objectives I mentioned for the FASB is to clarify when do you apply the liquidation basis of accounting. And the FASB in this ASU determined that you should prepare financial statements on the liquidation basis when liquidation is imminent. And so I think when most of us think about imminent, we think of the Webster's definition, which is, quote, likely to occur at any moment. That's very much different than the definition of imminent that the FASB is using in this ASU. So when you think about imminent in the context of this ASU, it's really defined as being principally related to a plan for liquidation being approved by the person or persons with the authority to make the plan effective, and that the likelihood being remote that either the plan gets blocked by an outside party or that the entity will return from liquidation. Conversely, imminent can also be when a plan for liquidation gets imposed by a third party that's outside of the entity, when it's similarly remote that the entity is expected to return from liquidation status. So I'll highlight that point because as preparers think about potential liquidation accounting issues and thinking imminent is the threshold, as you can see by this definition, it's really tied to an approval of a plan, which could happen months, quarters, or even years before the liquidation occurs. And so it's an important point to be thinking about as you consider when you might need to apply liquidation basis. The other item I wanted to highlight related to recognition is that the FASB staff did consider what do we do with limited life entities. So these are entities where there's a plan for liquidation may have been specified in the governing documents at the entity's inception. And so if you're in that sort of a situation, the ASU would indicate that you would not be applying liquidation basis of accounting. However, you would need to monitor if there were events or circumstances that occurred that might change that plan that was specified in the governing documents at inception. And if you did have such changes, then you would be required to apply the liquidation basis of accounting. So I think this is definitely an area of judgment within the ASU. And within the basis, they actually talk about some of the primary indicators. And so if you have a limited life entity, one of the primary indicators you'd be looking to is if the change in the plan for liquidation results in you selling your assets for less than fair value. So if that's going to occur, that might be an indicator that you do have a change in the plan and that liquidation basis of accounting may need to be reported. The other item I'd highlight on scope is that this will apply to all entities except for investment companies that are regulated under the Investment Company Act of 1940. So with that kind of foundation on when we apply, let's move on to the next slide on recognition and measurement. So we've addressed the when do you apply it. Now we're really moving into the second part of the FASB's objective, is to give guidance on how do you go about doing it. And so within the ASU, they provided recognition and measurement guidance for assets, liabilities, and other income and expense. And so we'll start and highlight the key provision of measurement for assets. And that is that you're going to measure assets at the expected amount of consideration that you expect to collect in settling or disposing of assets through liquidation. And so the key here in reading through the basis for this ASU is what you're trying to paint a picture of is, of all of your assets, what is ultimately going to be available to be distributed to the investors upon liquidation. And so that's, when you're estimating that, I think that's the lens that you look through, and you're really thinking about how much cash am I going to collect when I sell off these assets. And then the other key unique provision, and this is potentially a key focus area for preparers, is that you would include previously unrecognized items that you would expect to sell. So these might be things such as unrecognized intangibles like a trademark. If, as part of your plan for liquidation, you're intending to monetize that asset and you have a reasonable basis for estimating what you think you'll be able to sell it for, then you would accrue that and report it as an asset under the liquidation basis of accounting. So clearly, this is an area where there's going to be a lot of judgment involved in terms of what is your specific plan for liquidation, what are your potential buyers, what are the assets that the buyers might be interested in, and that the management or preparers are left to think through when they're preparing a liquidation basis financial statements. The standard also highlights that fair value may approximate the amount that an entity expects to collect. However, it is not presumed to be true for all assets. So when preparers think about the assets that they've got reported at fair value, I think the thing that you need to be thinking through is how might the reduced time horizon that might be forced upon you in your plan for liquidation impact your ability to collect what you've previously reported at fair value for some of these items. For instance, if there's not an active market for certain of the assets, do you need to take additional haircuts on fair value of those in order to basically monetize those assets? And then lastly, the provisions would require you to accrue estimated costs to dispose of the recognized assets. And when you accrue those costs, you would present them in the aggregate and separately on the balance sheet from the related assets. And when you think about accruing those costs to dispose, you would not be applying any discounting provisions in measuring the accruals for disposal costs. So that's basically the guidance for the asset side. Next, we'll move on to the liability side. I think it's a bit more straightforward on the liability side. It's just that you're going to recognize your liability based on existing requirements of otherwise applicable U.S. GAAP. And you'll adjust your liabilities to reflect any changes in the assumptions that might result from the decision to liquidate. So as I mentioned before when I was talking about the asset side, if as measuring some of your liabilities, a key component is, for instance, the extended timing of payments, you'd obviously be moving those payments forward, and that might potentially impact the measurement of those liabilities. When you think about liabilities, you should also not anticipate any legal release of liabilities when measuring those. So that's basically assets and liabilities. On the next slide, we'll move into other cost and income. And so on the other cost and income side, you're basically required to accrue amounts that are expected to be incurred or earned through the end of liquidation if and when the entity has a reasonable basis for estimation. And similarly, you'd not be applying discounting provisions in measuring expected income and expense. So I highlighted some concerns on the asset side. I think for income and expense, there'll also be some significant judgment areas. Potentially difficult judgments needed to be made around what constitutes a reasonable basis for estimation when you're thinking about accruing income and expense. Another item that I'd highlight on the other income and expense side, which is not necessarily clear in the ASU, is what is the interplay between the provision for expenses in this instance and the liability provisions I mentioned on the previous slide. Because clearly if you're accruing expected expenses, that would result in a liability which would potentially violate some of the provisions of measuring liabilities under existing U.S. GAAP. So under the ASU, it's not entirely clear what takes precedence there as it's drafted. And then the last item to be addressed on this slide is subsequent measurement. So under the ASU, it's contemplated that at each reporting date, you're going to remeasure your assets and liabilities and your accruals for disposal or other costs and income to reflect your actual or estimated change in value since the previous reporting date. So I believe it's contemplated as you move forward at each reporting date, you're going to need to be thinking about whether you have updates as well as whether you've developed a reasonable basis for estimating things that you previously didn't have a reasonable basis for. All right, with that, let's move on to the last couple of slides highlighting guidance in this area. So as it relates to presentation and disclosure, the ASU, in addition to the term liquidation, also introduced two new terms for statements. And those two new terms are the minimum basic financial statement presentation under the liquidation basis. So if you are on a liquidation basis of accounting, you would be required to prepare at a minimum a statement of net assets in liquidation, and that basically presents liquidating entities' net assets available for distribution to investors and other claimants as of the end of the reporting period. Similarly, you'd also be required to prepare a statement of changes in net assets in liquidation, and that presents the changes during the period in net assets available for distribution to investors and other claimants. Then moving on to the bottom part of the slide, and I think the disclosure requirements for the standard are key. And the first provision of the disclosure requirements is that you are to apply any other disclosure requirements required by other topics that are relevant to understanding the financial statements prepared under liquidation basis of accounting. And in addition to that general requirement, then there's these four kind of new unique disclosure requirements for liquidation basis of accounting. So the first specific requirement that you include a statement that the financial statements have been prepared using a liquidation basis of accounting, and that you would include all the facts and circumstances around the adoption of the liquidation basis of accounting. You would also include a description of the entity's plan of liquidation that would include how it expects to dispose of its assets and liabilities and the anticipated duration of the plan. You'd also need to disclose the methods and significant assumptions and any subsequent changes to those used to measure the assets and liabilities, and you'd disclose the types and amounts of costs and income that are expected to be accrued. So with that as presentation and disclosure, let's move on to the last slide of this topic, which is effective date and transition. This ASU will be effective for both public and non-public entities that determine liquidation is imminent, as defined in the standard, during annual reporting periods beginning after December 15, 2013, and interim periods within those annual periods. Early adoption will be permitted. So when you actually go to apply the standard at the effective date, you will record a cumulative effect adjustment that is required to account for the differences between measurements under the liquidation basis of accounting and the existing going concern basis of accounting. And then the last provision indicates that entities that are already reporting on a liquidation basis of accounting under existing U.S. GAAP about when and how to apply a liquidation basis of accounting, for instance, terminating employee benefit plans, are not required to newly adopt the ASU's provisions and may continue to apply existing guidance. So in wrapping up the podcast, we're excited that the FASB took this project on to provide increased guidance related to how to apply the liquidation basis of accounting, and are looking forward to future developments as the FASB works on their going concern project. This concludes KPMG's podcast on the FASB's ASU 2013-07. You can find more information on this ASU on the Financial Reporting Network, including our Defining Issues 13-023 that announced the development of the liquidation basis model. Thank you for listening.